Hi, good morning. We are starting the webinar now. Today, we are doing something different. We are having someone from the Global Markets Desk who will present to you on the German market and introduce one stock that's listed in Germany. Okay, I'll hand it over now.
Good morning, everyone. For today's presentation, I will be covering the European economic outlook and narrow into the German market. I will also talk about the Frankfurt Stock Exchange, which is the largest of the 7 stock exchanges in Germany. Following, I will touch on 2 German ETFs and 1 German counter that investors should look out for in view of the current investment and economic climate. Since the onset of the global financial crisis in 2008, the US Federal Reserve has implemented quantitative easing to stimulate the economy when standard monetary policy has become ineffective. The US Federal Reserve balance sheet held 700 billion to 800 billion of treasury notes before the recession. After 3 rounds of quantitative easing, purchases of mortgage-backed securities were halted on 29 October 2014 after the Federal Reserve accumulated 4.5 trillion in assets. In the same period, the S&P has risen by an astounding 234%. As for the EU, purchases of 60 billion per month of euro area bonds from the central governments, agencies, and European institutions were bought beginning March 2015 and was planned to last until September 2016 at earliest, with a total QE of at least 1.1 euro trillion. The Eurozone interest rates are slated to be kept low at around 0.05%, and these initiatives are targeted to increase money supply, which continues to keep interest rates low and spurs spending and borrowing. Next up, what's ahead for the German market? According to the OECD forecast for Germany, there are 6 major points. Firstly, Germany's economic outlook is projected to strengthen, driven by both domestic and external demand. There is continued robust in the labor market. Low interest rate and low oil prices will continue to spur household spending. The recovery of the euro area and the depreciation of the euro will boost its exports growth. Business investment is expected to recover as capacity utilization rises. The already low unemployment rate will fall further, while consumer price inflation is projected to rise in 2016. The current account surplus is projected to remain high, and Germany has the flexibility to reduce its structural budget to increase long-term growth, enhancing government spending. In the government sector, investment has fallen short of depreciation over the past 10 years, and such investment in transport infrastructure could be a potential area of content. While the residential investment has expanded robustly since 2009, non-residential fixed investment and spending on knowledge-based capital has remained subdued, even as financing conditions are good. Thus, there is a room for investment in this area. In the next few slides, we will proceed to elaborate further on some of these points. The chart on the left shows that there is room for investment spending. As a region, the OECD has lagged far behind emerging economies in total fixed investment spending. With reference to Germany, the charts below indicates that spending has been relatively flat for the past 2 years, which suggests that there is room for higher infrastructural spending. The industrial and manufacturing landscape in Germany has shown resilience. For the Germany PMI data, the previous weakening in 2014 has now shown signs of strengthening in 2015, which signifies a positive sign for German exports. Despite falling in July, the industrial output has rebounded to increase by 0.7% in August and has remained near the neutral line. This suggests that there is room for further improvement. Without a doubt, Germany maintains a healthy trade balance as characterized by its continued uptrend. On the sentiment end, there is a positive signal from the ZOO survey. If you are wondering what is this indicator, the ZOO survey is ascertained by 350 financial experts, which reflects the difference between the share of analysts that are optimistic and pessimistic on the economic development in Germany for next 6 months. To elaborate further, the point on trade balances from the previous slide, Germany runs the highest trade surplus, or one of the highest in the world. If we were to examine the top 3 contributors, the US would have been a common factor over the past 14 years. We could safely infer that the state of the US economy has a significant importance to Germany's trade balances. It is also interesting to note that China has made it to the 4th place and South Korea not far below. As such, the German economy will be increasingly affected by Chinese demands for its goods. Indeed, Germany has a robust labor market. On the first chart on the top left, its unemployment rate stands at a 5-year low of 6.4% dated as at August 2015. The next graph shows its household income growth, and it dates back until year 2000. But in the recent 5 years, there is an evident year-on-year growth, and this positive trend indicates potential strength for consumer spending. In the forecast of GDP growth by IMF this year, based on current prices, Germany is expected to maintain its position as the 4th largest GDP in the world until year 2020. This is quite remarkable for a country size almost equitable to the size of only California. But of course, there are some risks to consider when investing in Germany. As a member of the EU, Germany is affected by the woes of its neighbor. In the middle of 2015, the Greek crisis has caused stock markets in the Eurozone to correct heavily. The charts that you see reflects the upcoming yearly debt maturities of its indebted neighbors, starting from year 2015 running till year 2045. For Greece, 2015 is the year where a high portion of its debts run due. For 2016, in my opinion, the risk may arise from other neighbors. At a debt to GDP ratio of more than 130%, Italy is the highest after Greece, and the next 2 years represent a high amount of debt maturity for this country. As such, developments in Italy is worth keeping a lookout. And on to the next segment of the presentation, the Frankfurt Stock Exchange. The Frankfurter Wertpapierbörse is one of the largest trading centers for securities. With a share in turnover of more than 85% in the country, FWB is the largest of Germany's 7 stock exchanges. Deutsche Börse operates the Frankfurt Stock Exchange, an entity under public law. In this capacity, it ensures the functioning of the exchange trading. The Frankfurt Stock Exchange facilitates advanced electronic trading settlement and information systems. Thus, it is able to meet the steadily growing requirements of cross-border trading. Besides the specialist trading at Frankfurt Stock Exchange, its fully electronic trading system Xetra is one of the leading electronic trading platforms in the world. With the launch of Xetra in 1997, the Frankfurt Stock Exchange succeeded not only in strengthening in its competitive position, it also created attractive framework conditions for foreign investors and market participants. Today, the Frankfurt Stock Exchange is an international trading center. This is also reflected in its structure of participants, with some 110 out of 215 members coming from outside Germany. On to the second point, Germany is in a unique time zone. The trading hours of the FW market overlaps that of the Singapore market or other Asian exchanges and the US market. It is interesting to note that some US counters are dual listed on the Frankfurt Stock Exchange, which allows investors to get exposure to them before the US markets open. However, the liquidity and the bid ask spread could be different. In addition, the FWB market allows you to access ETFs, which provides exposure to other European countries. For instance, with the debt crisis 2 months ago, the Luxor FTSE Athens 20 ETF was in demand, which tracks the performance of the Athens index listed on FWB. We now know that there's other reasons to consider investing in FWB, but what do they have to offer? The first important thing to take note of in FWB is the DAX index. Before we jump into the individual stocks, this index is the total return index of 30 selected German blue chips, which uses their free float shares in the index calculation. The index has returned 4% year to date and has a PE of around 16 times. And with the DAX being a major index in the European market, there are ETFs that track its performance, namely the long and short DAX ETF. Their tickers are XDAX and SSDX respectively, and they are non-leveraged. However, a point to note that long DAX ETF is a direct replication of the DAX, while short DAX is a derivative-based ETF. As you can see, the performance of the ETFs are inverse to each other, with the white line for the long DAX and the yellow line for the short DAX. Next up, on some of the DAX components, you might be familiar with some of the brands shown on this slide. The top 15 market capitalization stocks for Zitra for DAX was selected, and you might be familiar with them. For instance, the Mercedes brands belongs to Daimler, and SAP SE develops software for enterprise financial solutions. Bayer Motoren carries the brand for BMW and is the world's largest maker for luxury cars. And Deutsche Bank has a global presence in many countries through its banking solutions and exchange traded products. On to the next segment for the stock that we have selected. We are examining in closer detail this company named Heidelberg Cement. It's listed on Zitra with a ticker HEIGY. Heidelberg Cement has a global presence in 2,300 locations with some 45,000 employees worldwide. It is a vertically integrated player in cement, aggregates, ready-mix concrete, and asphalt, and it has a strong global footprint in global urban centers. Also, it is one of the largest players in the industry. The company embraces a global corporate culture based on performance, sustainable development, and best practice sharing within the organization. Heidelberg does not venture into overseas markets solely as a foreign brand. Instead, a local market is often established with a local brand and hires a native to manage to derive better footholds in these markets. In its four business segments, their focus are on different niche, with the cement on growth markets, aggregates on mature and industrialization, RMC and asphalt on urbanization. Of course, there are positive trends in the macro that we favor this company. Firstly, there is growth in the building materials industry. Secondly, there's weakness in oil prices. Thirdly, there's weakness in the euro currency. And of course, there's improved margins by better processes. On the outlook of the industry, quoted from Bloomberg, Goldman Sachs continues to have a positive outlook on the European construction industry and sees real growth in Western Europe of 2.9% or 2.8% in 2016 or 2017 versus 2.6% or 2.5% earlier. Goldman Sachs also favor exposure to US building materials and market, as second half could see a rebound in activity after bad weather weakened first half. The company is positive in their business, with big trends continuing to support growth for the industry through 2019 due to factors such as population growth, urbanization, and a growing middle class. As you can see, Heidelberg Cement has a geographical presence in key urban hotspots in North America, Europe, Central Asia, Asia Pacific, and Africa. Heidelberg Cement can benefit in many aspects from a decreasing oil price. For instance, lower energy costs allows Heidelberg Cement to reduce spending on energy per year. Currently, Heidelberg Cement spends on energy 1.5 billion euros per year, of which 250 million euros directly for oil and diesel. A decrease in energy prices hence has a positive impact on the cost side for Heidelberg Cement. And of course, there's a positive impact on growth in oil importing countries. Core Heidelberg Cement countries benefit through the low oil prices, example, US, Euro area, India, Indonesia, and Turkey. Lower spending on oil can have a direct positive impact on Heidelberg Cement through higher spending on infrastructure or indirect through a general increase of economic growth. This slide shows the analysis of the weakness on the euro on Heidelberg Cement. As you can see, Heidelberg Cement generates 87% of its revenues and 89% of its EBITDA outside the Eurozone. Thus, a 10% depreciation of the euro would lead to a, firstly, 9% increase in EBITDA and 3% decrease in net debt. The company continues to pursue continuous efficiency improvement. As you can see, year on year, the company has different teams to improve their business processes. For 2014 onwards, the company focuses on supply chain management improvements. Under process improvements, in the last area, you can see that the company pursues Customer Excellence Program and Continuous Improvement Program for year 2014 onwards. Entering the next efficiency level, the company targets to have an improvement in 120 million euros of sustainable results improvement by 2017 and 150 million euros reduction in logistics related costs. And of course, we see margins improvement in all regions. For every region, with North America being one of the biggest contributors, there is a 346 basis points improvement from Q1 2014 against Q1 2015. And of the highest basis improvement, we have the African Mediterranean Basin, which has a 651 basis improvement year on year. The second quarter 2015 results for Heidelberg Cement has been comforting. In most of its regional segments, the volume growth is experienced, with the best performer by percentage in the African Mediterranean Basin and worst region in the Asia Pacific. On the group level, all product segments continue to experience growth year on year. Growth in sales volume does not tell the complete picture. The company EBITDA margin continues to improve and has been growing for 7 consecutive quarters, achieving a 20.7% margin in the most recent quarter. On an annual basis, the company maintains a steady EBITDA and free cash flow generation. Of course, investors may worry that a potential source of concern could be their debt levels. In the next slide, we are able to see that the company has been prudent in managing their debt, with net debt to EBITDA dropping to 2.5 times, in line with their strategic target. This suggests sustainable growth of the company business while deploying leverage. The company is unlikely to expect an urgent need for cash to meet debt commitments as the company spreads out its debt maturity evenly over the next 6 years. And of course, the company does not forget about achieving returns for its shareholders. There are three areas which they explore to improve shareholder returns, either through strong cash generation, share buybacks, or increasing dividend per share. These points will be further elaborated in the slides ahead. The company expects to have free cash flow generation grown at 18% CAGR over the next 5 years. There's 5 years of cumulative free cash flow of 8.8 billion euros in the pipeline as well. The company has planned share buybacks to achieve shareholder returns as well. Firstly, they try to achieve and maintain solid investment grade ratings, followed by assessment of key projects with higher expectation returns, assessment of unallocated free cash flow and consideration of capital needed for other projects, and also lastly, to deploy excess cash to shareholders through share buybacks. And at the end of the financial year, the company does not forget to thank its shareholders as it works towards achieving a higher but not exorbitant payout ratio. The target is to reach 30 to 35% in 2015 and 40 to 45% in 2019. But of course, the company is also clear in relaying its capital allocation priorities to its shareholder. This chart is an example of the thought process the company goes through before deploying its free cash flow. Firstly, any free cash flow will achieve deleveraging of its solid IG ratings, to invest in organic growth, which generates more available cash, and thereafter discipline M&A. Or the company will actually turn the free cash flow into progressive dividends to return capital to its shareholders. On the outlook of their business, in North America, Heidelberg Cement, in conformity with the IMF, expects a continuing economic recovery and consequently a further increase in demand for building materials. Besides new residential building, commercial and infrastructure construction is also making an increasingly strong contribution to this growth. In Eastern Europe, the crisis in eastern Ukraine is impairing the sales volume and results of that country. It has not yet had a significant effect on the operating activities in Russia. However, the currencies of both countries have depreciated considerably against the euro since the crisis began. Markets should continue to stabilize, and the first impetus is expected to stem from the EU's new infrastructure program. In Western and North Europe, positive market developments is expected. This is based on the recovery in the United Kingdom, the consistent solid condition of the German economy, and stable economic development in Northern Europe and Benelux. In Asia and Africa, the group continues to expect sustained growth in demand, albeit a weakening growth in China. In view of the positive development of demand and the commissioning of new capacities, Heidelberg Cement anticipates an increase in the overall sales volume of the core products. A moderate rise in the cost of raw materials and personnel is expected due to the forecast of growth in sales volume, the elimination of subsidies for electricity and fuels in Indonesia, and partially because of the devaluation of the euro. To this end, process optimizations are expected to achieve a sustainable improvement in results of at least 120 million euros by the end of 2017. For 2015, HeidelbergCement anticipates a significant decrease in financing costs because of its noticeable decline in net debt. Furthermore, the company wants to reduce leverage to a level that enables a solid investment-grade rating. They will also focus on accelerated growth and higher returns for their shareholders. The payout ratio is expected to increase from 29% in 2014 to between 40 to 45% in 2019. They are confident about 2015 and they will continue to benefit from the positive development in North America, the United Kingdom, Germany, and Northern Europe. These countries generate about 50% of their revenue. And to sum up, the investment merits recap: lower oil prices are likely to result in fewer savings potential. Weaker euro translates to higher profits upon repatriation. Local markets presence with local banks is their business strategy. Strong market position and cost leadership is one of the key factors they consider in running their business. And also, they are the likely key beneficiary of increased German infrastructure spending. Amidst the merits that we have just explored, let's not forget the business risk that the company carries. An increase in interest rates could affect its cost of fund. Slowdown in infrastructure works could actually dampen the demand of its products. And of course, a long-term prolonged crisis in Ukraine and Russia could affect its revenue from Eastern Europe, Central Asia region. HeidelbergCement is well covered by many analysts, with 23 analysts calling for a buy and a 12-month consensus target price of 81.75 euros against the current price of 66 euros. Most noticeably, Goldman Sachs has called for a buy/neutral with a target price of 96.2 euros. Okay, we have come to the end of the presentation and we are open to take any questions.
Hey, hi there. It's Ken here. Just a quick question on, do you see the current pullback in the US markets as a pullback or a reversal of trend? If you refer to a report maybe about 3, 4 months ago, I mentioned that we were in the midst of probably a bigger correction. And so this would be the second leg of a pullback, which means that there's probably one more leg down before it actually goes up. Um, I mentioned that the current correction in the US market looks like a major four of an Elliott wave, and the most recent price pattern and volume trends seem to support that. So because the US markets, I'm expecting further weakness in the weeks ahead. There'll be implied weakness on the STI as well. So for NEK who asked about the outlook for STI, I think STI will remain weak or consolidatory in nature following the US markets. So I would say that to be a bit cautious in the next few weeks ahead. But then after a few weeks ahead, you can probably take advantage of, I would like to say, one could be one final move before the bull market is ended. Yeah. So I hope that answers your question.
Hi. Okay. Since there are no more questions, we will end the webinar here. See you next week.